morning and Happy New Year. Your Excellencies, members of the Monetary Board, the senior advisors to the Prime Minister, Auditor General, secretaries of the ministries, senior Deputy Governor, Assistant Governors, and other senior colleagues from the Central Bank, distinguished invitees, ladies and gentlemen. It is a great pleasure for me to warmly welcome you to the presentation of the roadmap of the Central Bank of Sri Lanka, which articulates the broad direction of monetary and financial sector policies for the period 2019 and beyond. The roadmap is a well-received and important document which delivers several benefits to the stakeholders of the economy. We expect that this announcement would guide and shape your own policies and plans effectively, which will ultimately contribute to the overall economic development of the country and better living standards of the people. Let me begin by explaining our policy stance and our assessment of the economy over 2018. The broad structure of the roadmap is to start with this assessment and then to move on to monetary policy, then financial sector stability policies, subsequently to our agency functions, and then some concluding remarks. So, by way of introduction to the basically the review of the economy, the Sri Lankan economy faced heightened challenges in 2018, emanating mainly from the global economic, financial, and geopolitical developments that adversely affected the external sector. There were also several domestic challenges. Political uncertainties, especially during the last quarter of the year, amplified the challenges to overall macroeconomic stability. Subpar economic growth continued in 2018, following subdued growth in 2017. Favorable weather conditions supported a rebound in the agriculture sector, while expansion in the services sector has been broad-based. However, industrial activities slowed in 2018, mainly due to the slowdown in the construction sector. Consumer price inflation remained low in 2018, in spite of temporary ups and downs due to volatile food prices and administrative price adjustments. In response to the tight monetary policy stance pursued by the central bank during the past 2 years, monetary and credit growth decelerated in 2018 from the higher levels observed in 2016 and 2017. Despite this, an adequate expansion of domestic credit flows, driven by demand from the private sector, was witnessed during the year. Being guided by these developments, as well as considering impending risks and challenges, we followed a cautious approach in relation to monetary policy conduct in 2018. Taking into account the favorable developments in inflation and inflation outlook, as well as the subdued performance in the real economy, the central bank signaled the end of monetary policy tightening that commenced at end 2015 by reducing the upper bound of the policy interest rate corridor in April 2018. Nevertheless, considering the impact of global developments that affected external sector stability of the economy, the central bank has not implemented further loosening of its monetary policy stance since then. The sustained high deficits of rupee liquidity in the domestic money market compelled the central bank to reduce the statutory reserve ratio applicable on all rupee deposits of commercial banks in November 2018, while increasing policy interest rates to neutralize the impact on interest rates due to the permanent liquidity injection arising from the reduction in SRR. We followed this cautious approach with a broad aim of stabilizing inflation in mid-single-digit levels and anchoring inflation expectations to enable the economy to reach its potential in the medium term. In the external sector, the growth in export earnings was outpaced by the expansion in import expenditure. Although earnings from tourism, workers' remittances, foreign direct investment, and debt-related inflows to the government helped cushion the balance of payments to some extent. The BOP experienced significant pressure on account of foreign exchange outflows caused by tightening global financial conditions and the strengthening of the US dollar in view of monetary policy normalization, particularly in the United States, as well as the widened trade deficit. So there were both exogenous as well as domestic factors which caused these pressures. Similar to that pressure that was observed in other emerging market economies, these developments resulted in a sharp depreciation of the Sri Lankan rupee, particularly during the second half of the year. The central bank has intervened in the domestic foreign exchange market at times to prevent disorderly adjustments of the exchange rate, while allowing demand and supply forces to determine the forex level, its direction, as well as its level. The government and the central bank introduced several short-term measures to address the pressure in the external sector. The external sector developments once again highlighted the need for structural reforms to boost the tradable sector, particularly by enhancing merchandise and services exports in the medium to long run. The external sector was also affected by political instability during the latter part of 2018. Political developments, compounded by concerns regarding fiscal slippage in the lead-up to the elections, were significant causal factors in the decisions of all three major rating agencies to downgrade Sri Lanka's sovereign rating. This, in turn, negatively affected investor confidence. However, such downgrading, only on the premise of heightened political uncertainty and anticipated rather than actual fiscal slippage, cannot be justified, as there was no solid evidence of a deterioration in the macroeconomic policies or in macroeconomic fundamentals. This was evidenced by the good progress that was made in completing the fifth review of the extended fund facility of the International Monetary Fund until 26 October 2018. Sri Lanka continued to receive the assistance under the EFF, and we received the fifth tranche of the program in June 2018. We look forward to the successful completion of the IMF-EFF program in 2019. We are optimistic that staff-level agreements reached in principle with the IMF on the 26th of October on the fifth review will proceed to the next level in the coming weeks. Although the government continued its efforts towards fiscal consolidation, the performance on the fiscal fronts was rather mixed in 2018. Lower than expected revenue collection is likely to challenge the achievement of the targeted budget deficit in 2018. However, the primary balance is expected to record a surplus for the second consecutive year in 2018. This would be only the third time since 1955. Continued fiscal consolidation remains essential to build on the achievements already realized in the fiscal sector and to support the conduct of monetary and exchange rate policies without any fiscal forbearance. As announced in last year's roadmap, the central bank is progressing towards implementing flexible inflation targeting as its new monetary policy framework by 2020. We have taken several policy initiatives to facilitate the transition to FIT during 2018. While maintaining appropriate policy coordination with the government, we initiated the drafting of necessary legal amendments to strengthen the mandate of the central bank to maintain low inflation while strengthening its autonomy, transparency, and accountability. During 2018, we were also able to implement several policy measures with a view to maintaining a stable financial system with subdued macroprudential concerns, while increasing the resilience of the financial system to global and domestic shocks. In order to strengthen the legal and regulatory framework of the financial institutions, a new Banking Act is being drafted, while also initiating amendments to other legislation related to the financial sector. Resolution actions for distressed companies were taken in the form of imposing stringent regulatory actions, such as restriction on business, as well as suspension and cancellation of licenses. Consolidation will be encouraged both in the banking and non-bank sectors through a steady increase in capital requirements. Priority will be attached to achieving sustainable structures in both the banking and non-bank sectors in an orderly manner. It is our intention to send out the clearest possible signal that there will be no regulatory forbearance in this process of trying to consolidate the banking and non-bank financial sectors. We also continued to take measures to strengthen the payment and settlements infrastructure in line with our statutory responsibility of developing an efficient and stable national payment settlement system capable of catering to the country's growing payments needs. To promote digital payment mechanisms in the country, a national standard for QR code-based payments was introduced during 2018, while progress is being made in establishing the national card scheme. The central bank also continued to perform its currency management function to facilitate smooth transactions in the economy while taking measures to preserve the quality of currency notes in circulation. Priority was also attached to strengthen the central bank's agency functions in 2018. Public debt management was carried out in a way that the government's financing requirements were met at the lowest possible cost with a prudent degree of risk while aiming to maintain debt sustainability. There was continued focus on sustaining the transparency and efficiency of the auction system for government securities, as well as on developing a viable medium-term debt management strategy. In consultation with government, we also initiated actions to implement the liability management exercises on future debt obligation based on the newly enacted Active Liability Management Act. The liberalization of foreign exchange transactions was advanced with the introduction of the Foreign Exchange Act No. 12 of 2017. Procedures for inward capital flows were further simplified and streamlined for smooth transferring of funds for investment, while limits for outward capital flows were enhanced in selected areas, giving local investors access to the wider global market. As a facilitator, the central bank continued its development finance and regional development activities during 2018 with the broad aim of enhancing inclusive and balanced economic growth and financial inclusion in the country. Progress was made in formulating the National Financial Inclusion Strategy. Further, the central bank worked towards improving Sri Lanka's global position with regard to implementation of anti-money laundering and countering of financing of terrorism regulations, and we entered into new MOUs with several government bodies and institutions during 2018 in this regard. We are working towards Sri Lanka being removed from the Financial Action Task Force's grey list by mid-2019. A number of measures have also been taken in pursuit of greater accountability and transparency. In particular, following the recommendations of the Prudential Commission of Inquiry to investigate, inquire, and report on the issuance of treasury bonds, measures are being taken to strengthen several laws applicable to the central bank. Measures were also taken to reform the operations relating to the issuance of government securities. A new auction system was introduced in 2017. Also, a new investment policy framework for the EPF has been introduced. The internal audit has been strengthened. We've introduced a code of conduct for both employees and the members of the Monetary Board. The procurement process for forensic audits is underway. There are 6 forensic audits, and these forensic audits are to be conducted by entities with a global practice. These are all the responses to the Presidential Commission of Inquiry. In a challenging global and domestic environment, the central bank is steadily improving its policy frameworks to mitigate possible risks and thereby achieve its broad objectives of economic and price stability and financial system stability. Our actions would be effective and yield desired outcomes only if certain conditions are met, especially the commitment of the government to macroeconomic stability. Given the prevailing low growth trajectory, growth-promoting policies and structural reforms are much needed priorities for the government. This must, however, be done without disrupting the fiscal consolidation process. For this to happen, the enabling environment must be created for the private sector to play a more active role. We need consistent and predictable policies from the government and more dynamic and a more dynamic and entrepreneurial mindset from businesses. We need both. We need predictability from the government and greater dynamism from the private sector. The government's initiatives aimed at improving the economic and social infrastructure of the country, enhancing productivity, upscaling skill levels of the labor force, as well as expanding domestic production capacity are vital elements to support an accelerated and sustainable level of economic growth. while maintaining a continued low inflation environment. Timely implementation of consistent and coordinated policies in a coherent manner is also essential to ensure the realization of the expected outcome of such policies. In this context, this roadmap intends to set the basis for strong policies and credible frameworks to achieve the macroeconomic stability with the support of the government and private sector stakeholders. Now, let me turn to the section on monetary policy strategies and policies for 2019 and beyond. Before embarking on that, I thought it would be useful to set the kind of landscape against which macroeconomic policy formulation takes place in this country. Sri Lanka is a twin deficit country, and there are three trends which give insights as to why we are a twin deficit country. Twin deficit countries are the most vulnerable basket of countries in the global economy. If one trend, if you look at government revenue, Mr. Paskalingam used to collect about 20% of GDP as revenue in the 70s, believe the 70s, sorry, 80s, 90s, and even in the 2000s. Consistently, the government was able to collect 18, 19, 20, 21% of GDP. That came down to 11% of GDP. So that is one trend. The twin deficit, the budget deficit, really has come about because of the significant reduction in government revenue from around 20% of GDP to 11, 12. It's now on its way up. It was, I think, 13.7% last year, right? 13.7% of GDP in 2017. And we need to get it up to about 16%, because, or 16 or even 17%, because we want to run a budget deficit of about 3.5% of GDP, which can be financed without amplifying our debt problem. So our expenditure level of 20% of GDP is actually okay. If you look at comparatives, that's an okay level. Of course, one can argue about the quality of public expenditure and improving the quality of public expenditure, but the overall level is okay. But to sustain 20% of GDP expenditure and have a budget deficit of 3.5%, which can be financed on a sustainable basis, we have to get revenue up to 16.5%, 17%. So that is really the challenge. So that's why one talks about revenue enhancement-based fiscal consolidation. So when people keep saying that this country is overtaxed, I'm not quite sure where they're coming from. We used to pay much more tax ourselves in the past, and our comparator countries all pay much more tax than we do. Then that's the one deficit. The second deficit, if you look at what's happened to exports, the second deficit, sorry, before I get there, the second deficit is the current account of the balance of payments. There, if you look at what's happened to exports, exports were 33% of GDP. Again, by 2014, 2015, it came down to about 12, 13%. So this, at the same time as we had this dramatic reduction in exports as a percent of GDP, the percentage of non-concessional loans in our stock of external debt went up from about 5% of the total external debt in 2005-06 to over 50% today. So exports came down, non-concessional debt went up, and this non-concessional debt was not used in projects which gave us a high rate of return. Not just a high rate of return. When you take external debt, you have to get a rate of return in the tradable goods sector. You have to either earn foreign exchange or save foreign exchange. So we did neither. So these two trends, exports come down, the stock of external debt has gone up. It's now about, I think, 35, 40% of total debt, and the non-concessional debt is over 50%. So you take all these things together, and this is why we are a twin deficit country. And that's the most vulnerable category, and that is the background against which macroeconomic policy has to be formulated in this country, i.e. we have very little room to mess around. We are really in a straitjacket. So having messing around, whether it's in economics or politics, is fraught with a great deal of danger. Okay. The central bank conducts monetary policy in an increasingly forward-looking manner with the aim of maintaining inflation at low and stable levels in the medium term, thereby supporting the economy to reach its potential. In 2018, the central bank conducted its policy in a challenging environment with rapidly evolving adverse global conditions, as well as several upside and downside risks on the domestic front. New developments in the global economy, in the wake of rate hikes in the United States, and economic normalization in most advanced economies have demanded monetary authorities around the world to adjust their monetary policies accordingly. The Central Bank of Sri Lanka also had to consider domestic developments, such as the depreciation pressure on the currency due to capital outflows and the widening trade deficit. These, of course, argued for an increase in interest rates. And there were other factors like subpar economic growth, deceleration in monetary aggregates and credit, moderate levels of inflation, high real and nominal interest rates, as well as continuing deficit liquidity conditions in the money market. And those factors support a reduction in interest rates. So you have to balance these pressures in terms of some indicators were arguing for an increase in interest rates, others for a reduction. Now, my old professor in macroeconomics, when I was an undergraduate, used to say that setting macroeconomic policy is like getting the best sound from a sound system, that you have to twiddle all the knobs, the bass, the treble, the volume, etc., to get the best possible outcome. And similarly, you have to twiddle the knobs, monetary policy, exchange rate policy, fiscal policy, to get the best possible outcomes. And macroeconomic policy making is as much an art as it is a science, because essentially, as I said, there are some indicators will point in one direction, another will point in another. So when commentators and analysts look at one indicator and say, well, look, you should be increasing interest rates, or look at another indicator and say, you should be reducing interest rates. But the challenge for the Monetary Board and the central bank officers who support the Monetary Board in this area is to look at all the indicators in a holistic way and see what the best possible outcome is in terms of monetary policy. The tight monetary policy stance pursued by the central bank since the end of 2015 by way of raising the statutory reserve ratio and policy interest rates yielded the desired outcomes, especially on demand-driven inflation and trends in monetary and credit aggregates compared to 2016 and 17. Such developments, in particular the favorable developments in inflation outlook, and trends in the monetary sector in an environment of lackluster growth performance, induced the central bank to signal the end of the tightening cycle in early 2018 by way of a reduction in the standing lending facility rate by 25 basis points. Nevertheless, global economic conditions and the pressure on the exchange rate has compelled the central bank to maintain a neutral monetary policy stance since 2018. Despite the low growth, etc., the external pressures, really at the moment the big vulnerability is in terms of our reserve, the pressure on the exchange rate and the pressure on the reserves. And you have to balance that against trying to support growth with an easier monetary policy. At the moment, the bigger urgency is to support the exchange rate and reserves. In the conduct of monetary policy, market-based policy tools, particularly policy rates and open market operations, were widely used, while the SRR was also used as a tool for injecting liquidity to the market on a permanent basis. In view of the large and persistent shortage in rupee liquidity, the Monetary Board decided to reduce the SRR applicable on all rupee deposit liabilities of commercial banks to 6% from 7.5% in November 2018. The reduction in SRR released a substantial amount of rupee liquidity to the banking system, which could have led to a reduction in interest rates and excess aggregate demand. Therefore, in order to neutralize the impact of the SRR reduction and maintain its neutral monetary policy stance, the central bank raised policy interest rates simultaneously. Since the announcement of the transition towards FIT, we have broadly maintained low levels of inflation in spite of some occasional upticks and downturns due to various demand and supply shocks stemming from the external and domestic fronts. Benefiting from prudent and proactive monetary policy measures that were also supported by several macroprudential measures, monetary expansion was contained at desired levels, thereby supporting the maintenance of low levels of inflation during 2018. As you all know, the central bank has an unblemished record of maintaining single-digit inflation continuously for a decade. This shows the central bank's strong commitment to price stability, which it considers to be of utmost importance to create an enabling environment for the economy to achieve an accelerated trajectory of economic growth and uplift the standards of the living people. The only way you can get sustained growth of 7-8% or more is to have a low inflation environment. Otherwise, what we have had is these repeating cycles of stop-go policies. As soon as the economy hits 6% growth, if you look at our economic history, it overheats. So we've got to find a way of really doing the structural reforms which drive growth rather than driving growth through loosening monetary policy. That's the easy option. Easy option is to create a sugar high by loosening monetary policy. That doesn't last more than a year or two, as we found time and again in our history. You've got to drive it through improving the growth framework, and that means structural reforms. The central bank will be resolute in preserving this achievement of a low inflation environment going forward, irrespective of domestic and international challenges that we may have to face. This is the prime reason why the central bank has embarked on a mission to upgrade the monetary policy framework with a view to strengthening the ability of the central bank to deliver sustained price stability amidst a rapidly evolving environment characterized by elevated uncertainty. During the year 2018, significant progress was made in the transition to FIT in terms of initiating necessary amendments to the Monetary Law Act, with a view to establishing a strong central bank mandate, building effective fiscal monetary coordination, and further improving technical and institutional capacity. Let me elaborate on a few important areas in relation to the progress towards FIT. Last year, we highlighted the need and the importance of strengthening the existing mandate of the central bank to perform its key tasks related to price stability. It is widely accepted that a strong legal mandate is an essential prerequisite for the successful adoption of FIT, as it is considered the linchpin that holds the entire framework together. Here, as an important step, the approval of the Cabinet of Ministers was obtained, in principle, to introduce a comprehensive set of amendments to the Monetary Law Act, particularly in the areas of strengthening central bank independence and facilitating the adoption of FIT as the monetary policy framework, in addition to other amendments to improve the governance of the central bank, strengthen financial sector oversight, and also to boost fiscal monetary coordination. Accordingly, the central bank, assisted by legal experts from the International Monetary Fund. In fact, the IMF has given us 2 lawyers from the Bank of Japan who have been tremendously helpful in helping us to review the Monetary Law Act. So the central bank is in the final stages of drafting the revisions of the MLA, which will address long-standing concerns, such as the focus on non-core and quasi-financial activities, monetary financing, as well as limits to central bank autonomy by way of clearly demarcating the powers and functions related to monetary policy. In addition, the remit of price stability will be elevated to the status of the prime objective of the central bank. The revised legislation will also facilitate institutional arrangements for setting inflation targets and improvements to monetary operations as well as macroprudential tools. These legislative amendments would not only improve the overall focus of the mandate, but would also boost the credibility of the central bank through an enhanced governance framework and autonomy, as well as greater accountability. We expect to submit the amended MLA to the Cabinet of Ministers and Parliament for approval this year. Another important element in our transition towards FIT is improving the skills, capabilities, and capacities of our staff, as well as the systems and procedures to establish a solid framework for forward-looking monetary policy conduct. A key step towards this advancement was when we partnered with the IMF 4 years back to develop a comprehensive, structural, model-based forecasting and policy analysis system, or FPAS, to enhance the monetary policy decision-making process. Substantial progress has been made in this regard, yielding a marked improvement in the modeling and forecasting capacity of the central bank, thereby enhancing the forward-looking monetary policy decision-making process. The details of this modeling framework are in the public domain now. Going forward, the central bank will focus on devoting resources towards further improving technical capacity and infrastructure, which would help generate timely and reliable model-based projections for macroeconomic analysis. The central bank has already planned to launch a number of new surveys and compile an array of new indicators to support monetary policy analysis. We continuously endeavor to improve the existing data collection and compilation efforts. These include several production trends-related early warning indicators, upgraded price indices, extension of PMI surveys to sectors that need focused attention, and several digitalization initiatives. We are also in the process of further expanding the household sector inflation expectation survey beyond the Colombo district through the countrywide data collection system with the intention of improving its coverage and precision. We have a number of school teachers around the country who've been given tablets, who give us real-time data on a regular basis for the various surveys conducted by our statistics department. As we have highlighted on many occasions, the strong commitment and the support of the government is essential towards adopting FIT as a framework for monetary policy. It's heartening to note that the government has recognized FIT as the prospective monetary policy framework for Sri Lanka, and it has been adopting policies aimed at fiscal consolidation in the medium to long term. We welcome the government's efforts related to revenue-based fiscal consolidation, which is aimed at raising revenue while rationalizing expenditure for the government. We expect that implementing the new Inland Revenue Act, improving tax administration supported by the full rollout of the RAMIS system, and improving tax compliance will be instrumental in raising revenues. In addition, introducing measures to rationalize expenditure, strengthen public debt management through the enactment of the Active Liability Management Act, and introduce required reforms to state-owned enterprises, as well as reinforce the medium-term debt strategy aiming to contain the exposure of foreign currency liabilities were all encouraging moves by the government of Sri Lanka. Similar to other country experiences, the inflation target in the FIT framework is expected to be decided jointly by the government and the central bank. Hence, the FIT framework requires these two institutions to work together, as there should be no misalignment between fiscal and monetary policy. The central bank will continue to resort to active open market operations to manage liquidity in the money market, thereby guiding the short-term interest rate, which is the key operating target to navigate inflation in the targeted range. I wish to emphasize that the open market operations are a strategy to manage market liquidity to align short-term interest rates with the policy stance, and not a mechanism to print money by purchasing or holding treasury bills by the central bank, as wrongly interpreted by some analysts. A clear distinction must be made between such OMOs, widely practiced by the central banks all around the world, and monetizing the fiscal deficit through the central bank purchasing treasury bills issued on behalf of the government. The latter is essentially high-powered money. You print high-powered money when you finance the government's fiscal deficit. But open market operations are used all over the world to manage liquidity. Now, it has been said that the liquidity shortage in the market, in the money market, have been caused by central bank actions, such as, for instance, the unwinding of swaps, as well as the sale of dollars to prevent the disorderly depreciation of the currency. So now, if you look at just our open market operations, you can ask, why are you doing this? Why are you doing this open market operations and pumping money into the system? If you look just at that. But then if you look at the other side and you ask yourself, the currency has depreciated almost 16%. The real effective exchange rate is well below 100, so it is now undervalued. So is there no justification for the central bank to prevent what we think now is a disorderly depreciation of the currency? So we have to intervene to make sure that the depreciation of the currency, which is no longer aligned with fundamentals in terms of current account flows, it is being driven by capital outflows from the government securities market. That's foreigners who held about $2 billion worth of government, rupee-denominated government securities, have now brought it down to 900 million. That money has had to be fed through the market. And that has created a lot of pressure. In a thin market of somewhere between 60 to 100 million a day, if 10, 20 million of government securities money flows out, it clearly creates a imbalance between supply and demand in the market. So if we don't feed that, it clearly the depreciation of the currency would be very disorderly indeed. That it doesn't make sense to intervene in the market if there are current account related imbalances. If the current account outflows are more than the inflows, then you have to take a remedial action. And that has been done because there has been a deterioration in the trade deficit. Three sources of that depreciation. One was gold imports, which were about 200 million, went up to 600 million in 2017. And in the first 3 months of this year, we're going at a rate where the imports would have gone up from the original 200 million to over $1 billion. The reason was that we reduced the duty on gold to 0. And India had a duty of 15%. People imported gold on a duty-free basis into Sri Lanka and smuggled it to India. And that was one of the sources of pressure in the current account. Second was the motor vehicle imports. The reduction in duties, particularly for small motor vehicles, has meant that there has been a 196% increase in the import of motor vehicles up to September or October of this year. So this is why the central bank, in consultation with the finance ministry, has imposed these macro-prudential measures, which are these margins which have been imposed now, on import LCs for motor vehicles, as well as some duty adjustments. So the two main sources of domestically driven instability in the current account have now been addressed. The third source was oil prices. And there, fortunately, the international oil price coming down has helped, or will help to take some pressure off going forward. So those three main sources of instability in the current account have been looked after. But now what we need to do is change sentiment. We need to change sentiment at three levels. One is importers need to have confidence that they don't have to accelerate their imports and put pressure on the economy. That exporters start converting, or at least convert on a more timely basis, their export proceeds. And thirdly, the holders of government securities need to have greater confidence to hold our money. So those are really the challenges. There is no real kind of policy measure that we can undertake now, because we've taken the policy measures that are necessary to stabilize the FX market. Now it's a matter of confidence. It's a confidence in terms of the way we are managing the economy, both on the fiscal side, on the monetary side, and we must demonstrate the capacity that we are able to meet our external liabilities. So those are the challenges, and we are very confident that on all those three fronts, going forward, with the support of the government, we can do what is necessary. Further, we have implemented several measures to provide more information to market participants, thereby facilitating an efficient price discovery process in the financial markets. The central bank integrated the Central Integrated Market Monitor System was introduced in January 2018. The system captures vital market information from the call money, the government securities, and the foreign exchange markets. Daily liquidity estimation was further improved with the implementation of the liquidity reporting system through the CIMM. Further, a policy intervention by way of restricting non-bank primary dealers from participating in OMO auctions was made in the money market with the view to strengthening the signaling effect of OMO auctions. Regular usage of this facility by the primary dealers, the non-bank primary dealers, meant that it was really inhibiting the transmission of the signaling effect of the OMO auctions. The non-bank primary dealers continue to enjoy access to standing facilities and the intraday liquidity facility. Meanwhile, at the most recent policy rate adjustment, we narrowed down the policy rate corridor to 100 basis points with a view to reducing the volatility in overnight interest rates. Looking ahead, we are in the process of exploring the feasibility of a single policy rate instead of the current corridor system to give clearer signals on interest rates, reduce volatility in the call money rate, and increase the transparency in the monetary implementation process. Also, the haircut policy relating to pricing of securities will be reviewed in line with international best practices to ensure smooth operations in the money market. We will be looking into expanding money market activities in a comprehensive manner by introducing new instruments such as interest rate swaps and non-deliverable forwards. In order to improve the competitiveness of the banking sector, the central bank is planning to introduce a more cost-reflective alternative benchmark interest rate will be based on the marginal cost of banks. So we're having a new way of calculating the benchmark interest rates. Although we do not consider the exchange rate as an objective of monetary policy conduct, a market-based exchange rate remains a key instrument to facilitate inflation targeting. To this end, the central bank will continue to follow a more market-based exchange rate system, allowing the exchange rate to act as the shock absorber in the envisaged FIT framework. The FIT framework brings about a qualitative change in the pass-through of the effects of currency depreciation onto the overall rate of inflation. This is important. By adopting a forward-looking and proactive monetary policy formulation, the cost-pushed effects of depreciation can be countered by managing aggregate demand through interest rate adjustments to ensure inflation remains within the targeted rates. So the fear in the past, or the concern in the past, is that there would be a straight-through, pass-through of depreciation onto the price levels. So far, we have not seen it on this occasion because domestic production has become competitive in certain areas, which have helped. Also, because as I just said, the cost, if there is cost-push inflation coming through depreciation, because of the forward-looking monetary policy framework that we have, then the Monetary Board will have the capacity to adjust interest rates in a proactive way, which helps to counter the cost-push inflation by taking some demand out of the system through interest rate adjustments. So this relationship between depreciation and inflation, while it won't go away completely, can be managed better in the future. Being guided by this principle since September 2015, we have allowed greater flexibility in the exchange rate. However, during 2018, we saw a significant depreciation of the exchange rate amidst global market conditions, particularly with the surge in capital outflows, increased pressure on the current account, as well as excessive speculation in the market. During such times, we need to ensure orderly adjustment in the markets. Hence, it was necessary for the central bank to intervene in a prudent manner without sacrificing much of our reserves. Going forward, the central bank will continue to adopt an exchange rate policy with cautious interventions at times of excessive volatility in the forex market. This policy is also designed to maintain the competitiveness of the exchange rate and support the rebalancing of the current account, thereby supporting a gradual build-up of foreign exchange reserves as an external buffer. Now, going forward, I think there are some tailwinds as far as the exchange rate is concerned. As I said, we've addressed the domestic sources of pressure as far as the current account is concerned in terms of gold and motor vehicles. Oil prices have come down, and the general consensus now is that the rate of increase, rate of interest rate increases by the US Fed is likely to be more moderate than once originally thought. So the pressure from the external front is likely to be less as well. So if one takes all these things together, one hopes that there will be less pressure. The other factor, of course, is the rainfall. The fact that not only have oil prices come down, but the reservoirs are pretty full. So a hydro generation should play a significantly greater role in the time going forward. So these are all tailwinds which should help to bring the pressure off the exchange rate in the period ahead. Due to the reversal of foreign capital flows in view of rising global interest rates, the country's ability in financing the current account deficit through financial flows while strengthening reserves would be a challenging task. Without achieving a sustainable deficit in the current account and attracting long-term non-debt creating financial flows in the form of FDI, the external sector will remain vulnerable even in the medium and long term. Hence, a rapid boost in exports and FDI should be the priority for policymakers, without which the external sector will remain vulnerable to short-term domestic and external shocks. A significant growth of merchandise exports of at least 10%, with annual FDI flows in the range of US dollars 2 to 3 billion, supported by healthy earnings in the services sector and continuing contributions from workers' remittances, are needed to ensure a gradual rebalancing of the current account and a strong financial account. Hence, sustained measures are needed to improve investor confidence to ensure that short-term vulnerabilities are not translated into long-term structural deficiencies. Foreign reserve management of the central bank will continue to be based on model-based strategic asset allocation, which was developed with the support of the Reserve Advisory and Management Program of the World Bank. This methodology is expected to ensure that foreign reserves are managed with the objective of ensuring an adequate level of liquidity, a reasonable return in comparison to the benchmarks, and to exploit any active strategies with the view of making an excess return if the market conditions permit. Further, the central bank is in the process of introducing a superior alternative USD LKR reference rate for the benefit of all stakeholders, including foreign investors. As you are aware, in view of the deterioration in the BOP and to support the government's reform agenda, Sri Lanka obtained a 3-year EFF from the IMF in 2015, and we have already received 5 tranches of this facility. Although the developments over the past weeks have delayed that progress, delayed the progress that central bank has been Sri Lanka rather has been making under the EFF. We hope to keep the IMF program on track this year. While this will categorically support the country's external sector, the reforms would also help boost investor confidence and productivity of the economy. These are key drivers in enhancing the growth of the economy. As inflation targeting involves managing and anchoring inflation expectations effectively, transparency of monetary policy, particularly in terms of plans, objectives, and decisions, is of utmost importance. Hence, as transparency is achieved through effective communication, as a prospective inflation targeter, the central bank is very conscious of the need for a well-devised communication strategy. Accordingly, a number of initiatives have been taken by us to enhance the communication strategy. We have enhanced the analytical value of the regular monetary policy press releases with the support of the IMF, while maintaining clarity, simplicity, and enhancing the forward-looking approach. In addition, we have initiated programs on educating, particularly journalists and other stakeholders regarding the FIT. Further, several measures are in the pipeline, including the issue of a regular monetary policy report, which will be developed into inflation reports in the future, and expanding the public awareness outreach program, which will be implemented during the next 2 years as set out in the roadmap for FIT. Another important step, we recommence publishing an advance release calendar for regular monetary policy announcement. As in previous years, continuing this practice, we wish to present the advance release calendar for monetary policy announcement for this year as set out below. This document will be on the website, so you'll see there are 8 monetary policy announcements in 2019. The first is on the 22nd of February. As time is short, I'm going to press on. Currently, although the global economy is somewhat less robust than it was in the first half of 2018, the pace of global growth remains strong, pointing to further normalization of monetary policies in major economies. This has necessitated most emerging market economies to adjust their monetary policy in view of addressing economic imbalances associated with capital flows, currency depreciation, trade deficits, etc. Taking such trends into consideration and responding to domestic economic developments, we will continue to remain vigilant in formulating our monetary policy to ensure sustained economic and price stability in Sri Lanka. Next, financial sector policies for 2019 and beyond. In fulfilling the responsibilities entrusted by the MLA, the central bank continues to foster a vibrant, resilient, and strong financial sector which facilitates economic growth through efficient allocation of resources. In pursuit of this, the central bank acts as the apex regulatory supervisory institution of the financial system. It seeks to promote dynamic and stable financial institutions while facilitating an efficient payments and settlement system. In 2018, the financial sector performed well amidst challenging market conditions in the domestic as well as the global environment. Asset growth of the banking sector was at favorable levels, with the improvements in liquidity and capital levels, while financial outreach also strengthened during 2018, despite the slowdown observed in the non-bank financial sector. Strengthening the regulatory and supervisory framework of the banking sector remains at the center of our financial sector policy. During 2018, the regulatory and supervisory framework pertaining to licensed banks was further strengthened with the introduction of an array of policy measures in line with international standards and best practices. During 2018, the central bank issued directions on Basel III liquidity standards and directions on the leverage ratio. The directions on the leverage standards are also being issued. In addition, the central bank issued directions on foreign currency borrowings by licensed banks with a view to promoting transparency and further strengthening risk management aspects of foreign borrowings by banks. Meanwhile, to strengthen risk management, the central bank issued directions on financial derivatives transactions of licensed banks. A regulatory framework for appointment of agents was also issued. The direction largely focuses on the approval and selection process of agents, responsibilities of banks, permitted activities, risk management and oversight, customer protection and dispute resolution. Further adoption of the Sri Lanka Financial Reporting Standards 9, that is SLFRS 9, on financial reporting of financial instruments is another progressive policy measure adopted in line with international best practice. The central bank also issued guidelines to banks on the adoption of SLFRS 9 in consultation with the Institute of Chartered Accountants of Sri Lanka for consistent and prudent application of standards. The central bank has already initiated drafting a new banking act with a view to further strengthening the regulatory framework pertaining to licensed banks. The overall mandate for supervision and regulation, strengthening corporate governance, digital banking, consolidated supervision, resolution, monetary penalties and fines, ring-fencing, mergers, acquisitions and consolidations, subsidiarization of foreign banks, and differentiated regulatory frameworks for a tiered banking structure are key policy aspects to be factored into the proposed act. In addition, the Banking Sustainability Rating Index will be implemented from 2019 for risk-based supervision and planning the supervisory calendar. As banks are frequent targets for cyber attacks and other information security threats, a roadmap and a consultation paper were issued to improve technology risk resilience in the banking sector in line with international standards and best practices. A banking direction in this regard will be issued shortly. As a regulator, we believe that share ownership in the banks needs to be broad-based to strengthen corporate governance and to avoid ownership concentrations, dominance in the boards, conflicts of interest, and risks associated with related party transactions. Therefore, the existing requirements on share ownership will be reviewed and certain additional measures will be brought in. In addition, fit and proper assessment criteria for appointment of directors, CEOs, and key management personnel of banks will be strengthened further to appoint the most suitable and qualified individuals to the top positions in banks. Only persons with proven track records of good conduct and financial integrity would be considered for such appointments. Moreover, a broad-based policy on employment of expatriate staff, considering the needs for external expert contribution, will be introduced. Considering the significant development in the banking environment and the professional accounting auditing landscape, the minimum criteria for appointment of external auditors has also been reviewed, and the panel of qualified auditors will be amended accordingly. With a view to further strengthening the market conduct and practices of treasury operations of licensed banks, the central bank intends to establish a new regulatory framework to ensure the treasury operations of licensed banks are carried out prudently and in line with international best practices. The central bank will also formulate a crisis preparedness plan for the banking industry to minimize adverse impact on troubled banks and mitigate spillovers. A consultation paper will be issued to banks in this regard. As we firmly believe in the need for strengthening interregulatory cooperation and collaboration, an MOU was signed between the Central Bank, the Securities and Exchange Commission, and Insurance Regulatory Commission on risk-based consolidated supervision, where the Central Bank will be the lead regulator. As we have reiterated on many occasions, market-driven consolidation will be facilitated with the objective of promoting strong and dynamic banking and non-bank financial institutions to meet the financial needs of the economy more effectively while safeguarding the stability of the financial system. Now, the performance of licensed finance companies and specialized leasing companies slowed down significantly during 2018 due to low credit growth, declining profitability, and increasing non-performing loans. The slowdown in the sector was also a result of moderate economic growth and the impact of natural calamities such as floods, drought, floods and drought that prevailed in 2017 and the first half of 2018. Policy measures taken to curb excessive demand for vehicle imports have also impacted the sector significantly. Several regulations were introduced to strengthen non-bank financial institutions during 2018. A financial customer protection framework was introduced to protect customer interests and to strengthen customer confidence in the sector. A new capital adequacy framework for LFCs and SLCs was implemented with a view to fostering a strong emphasis on risk management and to encourage ongoing improvements in the risk assessment capabilities of the sector. In terms of the new framework, companies with assets of over 100 million rupees are required to maintain higher capital adequacy ratios. Moreover, a new direction on outsourcing of business operations was introduced to standardize outsourcing arrangements. A direction was issued to regularize the valuation procedure of the LFCs and SLCs regarding immovable properties. In the interest of depositors and stability of the system, several resolution actions were taken in relation to distressed companies during 2018, including cancellation of SIM licenses and introducing regulations on winding up LFCs. Going forward, the sector needs to cope with the enhancement of the minimum capital requirement and higher loan loss provisioning with the introduction of SLFRS 9. Further, the change in the regulatory posture of the central bank will result in early intervention against non-compliant, distressed, and high-risk LFCs. This will include regulatory actions, such as the restriction of business through deposit and lending caps, as well as suspension and cancellation of licenses. Further, guidelines are expected to be issued applicable for financial reporting of LFCs and SLCs. We will also consider issuing directions on ownership limits. In addition, capital levels of the sector are expected to be strengthened as a result of enhanced capital requirements. The LFCs and SLCs which are unable to comply will be encouraged to consolidate on a voluntary basis. Non-compliance will result in restrictions on deposit and business expansion and, where necessary, winding up of businesses. Therefore, it will be necessary for LFCs to give priority to capital augmentation plans in the near future. There will be no regulatory forbearance in this respect. Initiatives are being taken to resolve remaining distressed companies as per the provisions of the Finance Business Act No. 42 of 2011. Licenses of 2 distressed companies were cancelled, and the settlement of the liabilities of existing depositors under the Sri Lanka Deposit Insurance and Liquidity Support Scheme is currently underway. Amendments are proposed to the FBA to facilitate expeditious resolution actions in respect of distressed finance companies. During 2018, the central bank continued its efforts to strengthen the payments and settlements infrastructure of the country while developing an efficient national payment and settlement system which is capable of catering to the growing payments needs of the country. Let me mention some of these initiatives briefly. Approval has been granted to Lanka Clear Private to implement a national card scheme under the brand name of Lanka Pay in partnership with an international card scheme. This system was launched in 2018 with a licensed commercial bank commencing to issue Lanka Pay cards. As a result, the emergence of new payment technologies across the globe and the interest shown by the local authorities to keep abreast of these technologies, the National Payments Council, which is the Consultative Committee on Payments and Settlement Systems, appointed 2 committees, one on fintech, the other on blockchain. Both committees have reported. As per the recommendations made by the Fintech Committee, a national quick response code standard for local currency payments branded as Lanka QR was issued to all financial institutions and operators of mobile phones issued to all financial institutions and operators of mobile phone-based electronic money systems to facilitate QR code-based systems. Similarly, with regard to blockchain technology, an inter-industry working committee is preparing a framework for a blockchain-based shared Know Your Customer solution. Further, the central bank appointed a task force to study virtual currency schemes, to examine regulatory steps that need to be taken to ensure system stability and the safety of public funds. In addition, several regulations were issued in 2018 to ensure safe and efficient payment and settlement systems in the country. As for future plans and policies, the central bank will focus on promoting digital payment mechanisms to establish a less cash society with a view to reducing cash management costs while enhancing safety and convenience. Accordingly, we will facilitate the implementation of a national transit card and infrastructure framework for ticketing and fare collection for the purpose of introducing a nationally accepted transit card for the country to be used on bus and rail transport. We will also continue to adopt measures to promote the usage of digital payment mechanisms by way of encouraging financial institutions to enable digital payment methods and creating awareness among the general public on digital payment options and their benefits. It's also planned to establish a regulatory sandbox to enable introducing innovative fintech products while ensuring compliance with regulatory requirements. Turning to macroprudential surveillance, it's also notable that the Sri Lankan financial system has become more interconnected and complex than ever before and more susceptible to shocks. Accordingly, the central bank recognizes the importance of a more comprehensive macroprudential approach which goes beyond supervision at the individual firm level to look at broad market and economic factors that could have a material impact on the overall financial stability of the country. As we have already mentioned, stability of the financial system was preserved in 2018 amidst challenging market conditions with the help of timely macroprudential measures in addition to microprudential supervision and regulation. The central bank will continue to resort to macroprudential measures to stabilize the overheating sectors of the economy, which can undermine financial system stability. We expect to incorporate provisions for a stronger macroprudential framework into the proposed amendments to the central bank law. The amendments have a strong macroprudential surveillance component. There are new areas that we are looking at to operate under the macroprudential surveillance framework of the central bank. These include analyzing trends in the banking sector and non-banking sector exposure to the corporate sector, assessing the impact of dynamic provisioning frameworks on the banking sector, analyzing financial sector exposure to the household sector, evaluating the possibility of introducing escrow accounts to safeguard the residential property buyers and to achieve long-term stability of real estate market, as well as commencing multivariate stress tests for the LFCs covering credit market and liquidity risks. We have recognized risk management as a key strategic priority of the central bank, and we are in the process of implementing an enterprise-wide risk management framework, which is intended to promote a culture of informed risk-taking at all levels. Accordingly, the risk governance framework and the risk management policy of the central bank were approved by the Monetary Board in 2018, and relevant committees were formed and meetings were convened to make the framework functional. We expect to develop risk registers and implement an incident reporting mechanisms in 2019 with regard to financial risk management. We will further strengthen the risk management framework of fund management activities. With the growing priority being attached to achieving the Sustainable Development Goals as well as promoting greener and climate-friendly growth activities by providing productive and sustainable investment, the central bank initiated a process of promoting sustainable finance practices in Sri Lanka in 2017. If I can now turn to the ancillary and agency functions. First, currency management. Demand for cash has increased. New coinage was issued. Measures were taken against the willful defacement and mutilation of notes. A series of awareness-raising events were conducted. The construction of a currency storage facility in Rajagiriya has been initiated, and in the medium term, the operational flow in the currency department we redesigned with the introduction of new machinery. Those are the highlights of what is in the pipeline for currency management. Public debt management. During 2018, we encountered several challenges in government debt management due to interest rate normalization in the US, the skewed government financing requirements, as well as uncertainties in the political sphere. These factors affected the government's borrowing cost and imposed pressure on achieving targets under the medium-term debt management strategy, particularly towards the latter part of 2018, with the upward adjustment in yield rates and market preference for short and medium-term maturities. The new Treasury bond issuance system, which was introduced in July 2017, was reviewed at the end of the first quarter of 2018, taking into account the performance of the issuance system and the feedback from market participants. Several improvements, including an enhanced market-based acceptance arrangement as a prerequisite for the activation of Phase 3 of the auction system, are to be introduced by the end of the first quarter of 2019. Further, the auction calendar for Treasury bonds and bills was published by the Central Bank on a rolling basis with the view of improving transparency and predictability of the primary auction process. We are contemplating taking several measures to develop market and debt management practices in 2019. With the passage of the Active Liability Management Act in March 2018, we have laid the groundwork for liability management exercises in both the domestic and foreign markets. In consultation with the Ministry of Finance, we have already earmarked actions to implement liability management techniques on future debt obligations, and the proceeds mobilized would be maintained in a ring-fenced arrangement to meet future debt liabilities. All operations under the ALMA will be for mobilizing resources which will be earmarked purely for liability management. In addition, the medium-term debt management strategy is to be further streamlined with the assistance of multilateral agencies. We will also introduce amendments to the local Treasury bills ordinance and the registered stocks and securities ordinance to ensure smooth and efficient functioning of the debt management system. In view of the increased volatility in global financial markets, we also intend to reduce the threshold for foreign investment in rupee-denominated government securities from the current 10% of the outstanding government security stock to 5%. Clearly, foreign institutional investment tends to be volatile and footloose at the best of times, but in a global environment of increasing uncertainty, there is a case for reducing the exposure to that kind of capital flow, and therefore we are bringing down the limit from 10 to 5%. It's currently under 5%, so we will cap it at 5%. EPF, the new investment policy statement and guidelines for the EPF were introduced. The governance structure has been strengthened through the establishment of an EPF oversight committee in addition to the investment committee, which meets on a daily basis. The ADB has carried out a business review for streamlining activities. A new ICT system is being procured with the assistance of the World Bank. An EPF website will be launched shortly to facilitate web-based service delivery, and real-time validation of member details were continued through the online banking system in licensed commercial banks in 2018. So a great deal has been done and will be done to make the EPF operations more member-friendly. Foreign exchange. The new Foreign Exchange Act was introduced in 2017, at the end of 2017. Procedures for inward capital flows by foreign investors were simplified. Limits on outward capital flows were broadened in selected sectors. Foreign exchange transactions were relaxed with authorized dealers having general permission to transfer enhanced eligible migration allowances. We also intend to take actions to revisit liberalized capital transactions. In addition, we plan to review the criteria for granting permission for money-changing businesses to increase healthy competition amongst market players and reduce informal market activities. The monitoring function will be strengthened further by developing a new real-time foreign exchange reporting and monitoring system to capture data on foreign exchange sales and purchases. With a view to obtaining all data pertaining to cross-border and internal transactions in foreign currency, we intend to put in place a comprehensive international transaction reporting system. At the moment, we have difficulty in tracking repatriation of export proceeds. Now, with the assistance of the customs, the banks, we'll be putting in place this comprehensive international transaction reporting system, which will give us a much better idea of these flows. Meanwhile, as there are no clear provisions under the FEA to combat unauthorized and unlawful activities involving foreign exchange, several enforceable sanctions are expected to be introduced into the Foreign Exchange Act to enable the Department of Foreign Exchange to strengthen its surveillance of unauthorized foreign exchange market activities. The Financial Intelligence Unit. We will also act towards strengthening the national anti-money laundering and countering of terrorism financing policy framework of the country. Considerable progress has been made in completing the action plan agreed with the Financial Action Task Force, and our expectation is that Sri Lanka will be taken off the grey list by mid-2019. We have also expanded our reach by way of entering into MOUs with several agencies such as the SEC, the Insurance Regulatory Commission, and the Department of Motor Vehicles. Moving ahead, several progressive policies will be adopted with the coordination of all stakeholders to deepen financial intelligence services. And we've also really increased surveillance and monitoring over non-bank businesses and professions. Regional development. We continue to coordinate, facilitate, and implement various refinance, interest subsidy, and credit guarantee schemes while providing a range of credit supplementary services. In addition, to increase the level of financial inclusion, a series of financial literacy and skill development programs were also conducted, with a special focus on those who have not accessed the formal financial sector. We intend to continue these initiatives in 2019 as well. Most importantly, we initiated actions to develop a national financial inclusion strategy for Sri Lanka with the aim of promoting a more effective and efficient process to improve financial inclusion across the country. The National Financial Inclusion Strategy is expected to be launched by mid-2019 to bring in financially excluded segments to the formal financial sector, thereby promoting inclusive and balanced economic growth. By way of conclusion, ladies and gentlemen, at the outset, I mentioned that our country faced several difficulties during 2018, which threatened macroeconomic stability. However, in retrospect, I can record that the central bank and the government have implemented several policy measures to mitigate the impact of such challenges and uncertainties. And we have recorded a number of these in the roadmap. These measures have helped us to withstand certain shocks that we faced and to ensure broader stability of the economy in spite of some sectoral imbalances. Nevertheless, we do acknowledge that several challenges and threats still prevail, and there are a plethora of impending risks that may exert further pressure on overall macroeconomic and financial system stability. We believe that preemptive and effective policy measures would help us to mitigate those challenges and guide our economy and the financial sector in the right direction and ultimately achieve price, economic, and financial system stability. We stand ready to pursue policies and introduce any course corrections if they become necessary in today's volatile and uncertain world. Before I conclude, it is my duty to convey my deep sense of gratitude and appreciation to several parties who have constantly supported the efforts of the Central Bank. First and foremost, I am extremely grateful to His Excellency the President and the Honorable Prime Minister for their leadership and guidance. I would also like to thank the Honorable Minister of Finance for his support, especially to strengthen the independence in the Central Bank while ensuring close coordination between the Ministry and the Central Bank. Further, I owe a special debt of gratitude for the ample support and fruitful discussion and inputs from members of the Monetary Board of the Central Bank. My sincere appreciation goes to the Secretaries of the Treasury who served as ex officio members of the Monetary Board during 2018. I'm also grateful to Mrs. Ramanathan, Mr. Pereira, and Mr. Fonseca, whose unstinting support as members of the Monetary Board was extremely invaluable and very substantive. I'm also grateful to the Senior Deputy Governor, Dr. Nandalal Veerasinghe, and the Deputy Governors, Mr. K.D. Ranasinghe, Mr. S.R. Artigala, and Mr. H.A. Karunaratne. Their support and contribution in terms of the highly professional advice and excellent technical expertise helped me to discharge effectively my duties as the CEO of this iconic institution. I would also like to acknowledge the outstanding service rendered by former Deputy Governor, Mr. C.J.P. Siriwardena, who retired from the bank service last year. I'm also thankful to the members of the Monetary Policy Consultative Committee, the Financial System Stability Consultative Committee, as well as the Monetary Board Advisory Audit Committee for their valuable views and suggestions, which helped us immensely in better calibrating our policies and operations. A number of them are here. I'm deeply indebted to them for the time they have given to help us to refine our policies. Last and most importantly, I would like to express my sincere gratitude to the assistant governors, senior heads, and heads of department, particularly the Director of Economic Research and the staff of the Economic Research Department for their effort in producing this policy statement. It is my pleasure to acknowledge my colleagues in the Governor's Secretariat who support me on a day-to-day basis. I would be entirely lost without their assistance. In my view, the greatest asset of the central bank is its staff, without whom we cannot deliver on our mandates. I have thanked them all yesterday for the work that they have done in delivering our work. It's been done with a great deal of professionalism and technical excellence, and I would like to reiterate the thanks I expressed yesterday, today as well. I would like to conclude by quoting Ben Bernanke, Professor of Economics and former Chairman of the US Fed Reserve. The more guidance a central bank can provide the public about how policy is likely to evolve, the greater the chance that market participants will make appropriate inferences, which is what we are trying to do. We're trying to improve the way we do this, and that will be a constant effort on our part. I believe that policies and plans unveiled in relation to the monetary and financial sector would be, in this document, would be instrumental in ensuring continued stability in our economy. The effectiveness and success of those policies cannot be realized with your support, without your support as stakeholders. And I'm sure, as in the last year and in the past, you would continue to extend your maximum support going forward. Now, I'd like to finish on an upbeat note. You know, the feel-good factor in this country is influenced by two critical variables. One is rainfall, and the other is the price of oil. The reservoirs are full for agriculture and power, and the price of oil has come down significantly and is probably going to stay down. So I hope going forward, we can look forward to a much better 2019 where we all feel more upbeat. Thank you, and I wish you all a happy and prosperous New Year. Thank you very much.